Hey traders, this is Blake Morrow with Traders Summit, and with me today, it's Friday, and I have Mr. Jim Welsh from Macro Tides. He's joining us, and it looks like he's got a few things to say about some of the Federal Reserve members, I'm assuming. How you doing,
Yeah,
Jim?
I'm doing good, Blake. How about you?
Good, good. I mean, here we are, literally a few points away from all-time highs in the S&P. The markets are unshaken by anything at this moment, and it seems like that risk will continue higher. I mean, what's your take on this week's price action? The dollar, even though it kind of broke down, or excuse me, broke out, it's just kind of been consolidating
Right.
gains, but stocks are strong.
Yeah. Well, we're going to look at a table of the various stock market averages. And what we'll see is that the strength is extraordinarily concentrated. And if you look underneath the surface, which you and I have talked in recent months, how sometimes it's really important to look at other market averages beyond the S&P, beyond the Qs and the Dow to get a better idea of the market's internal health. And what the numbers show, and we talked about this last week in terms of market breadth, really weakening. So we went through a period of time, off the October low where breadth improved. But over the last 2 to 3 weeks, it's really weakened significantly. So, this week what we had, I think the major thing was FOMC Governor Waller gave a speech. And people on Wall Street kind of lumped him in the dove camp because, and this is just taking some comments back on October 10th, he made, Wall Street was worried about, oh my gosh, is the Fed going to raise rates again? That was the preoccupation. And at that point in time, the Fed funds futures were pricing in one more hike, right? And so he made the statement, I believe we can wait before making definitive moves on the path of the policy rate. In other words, I don't think we really need to raise rates, or we can wait. Well, that was, treated as good news, obviously, by Wall Street because it removed and lowered the probability of another rate hike. On November 28th, the theme was higher for longer, higher for longer, and what that might do to the economy. And Wall Street was worried about it. And, there is no reason to say we will keep it really high. In other words, we may not do higher for longer. Well, that was one of the reasons why the stock market rallied, in the month of December,
Yeah.
was based on this comment. So he gave a speech on Tuesday, Blake, and I think a lot of people on Wall Street were expecting him to reaffirm that, yep, I'm on board for a cut in March and, repeated cuts afterwards. And he didn't. And he said, with economic activity and labor markets in good shape, inflation's coming down to 2%, but I see no reason to move as quickly or cut as rapidly as in the past. So, whoa, wait a second. This guy isn't a dove. He's in what I've been calling the patient hawk group.
But he's in the patient hawk group, but his comments back in November, early December, that's what really spurred this move higher in risk.
Right, right. But again, what we see is always an exaggeration by Wall Street. And the bias is always what anything that's positive, we're going to jump on all over the place. And so that you're 100% right. In November, but really both those comments in October and November really shifted perception about what the Fed would be doing in coming months.
Jim, before we move on and we get into some of your charts of some of the other markets that you had brought, I want to look at the U.S. economic data, just for example, that came out this week. What we had, jobless claims were the lowest levels that we've seen since I don't know what level. I mean, what decade it was. Seriously.
It isn't that part, but because it was lower, obviously, a while back, but it's still nowhere hinting that, oh my God, an economic slowdown is right around the corner. Right. And that's one of the things I discussed in the January Macro Tides is, this economic momentum is going to continue in the first part of this year. And obviously those claims numbers that we saw, kind of reaffirm that.
Yeah. Well, okay. Then you have
and retail sales.
I want to say the consumer sentiment this morning.
Yep.
consumer sentiment was at 78.8 versus a 69.8% expected, or 69.8 expected. That's a huge jump. I mean, and then you got crude oil prices that are, still hovering around this, $70 range, and all these things percolating in the background geopolitically. I mean, isn't it going to be really tough to get inflation down? I still don't understand why the market is believing that there are going to be 6 cuts. I don't see the path. Show me the path on how they cut rates 6-7 times this year. I just don't see it.
I can't show you that path because I don't agree either. It's that simple. Now, as I discussed in the January Macro Tides, and I think one of the recent weekly technical reviews, if you look at the CPI, the takeaway for last December was 0.1. But in January and February of last year, so the next 2 months of readings that we're going to get, mid-February for January, March for February, the total takeaway value is 0.9. So if you add just 0.2, the core and headline are going to drop by 50 basis points. So a lot of this is statistical. And everyone is like, well, if you use a 3-month, over the last 3 months, it's 2%. I get it. And the theme is that, for me at least, is inflation's coming down. Yes, the Fed has room to cut rates, but they're not going to cut it 6 times because the unemployment rate is at 3.7, near a 50-year low. Capacity utilization is still above average, although it eased a little bit in the last month as well. And what the Fed is worried about, if we, under these circumstances, and we provide rate cuts, is that going to stimulate growth so that next year inflation is a problem of not coming down as much as we would like it. And that to me is the thing that Wall Street is missing. They're so myopically focused on inflation without looking at, okay, what is the Fed looking at? Inflation, but they're looking at the labor market. They're looking at the overall economy. They're looking at companies still raising prices because they can, because demand is still in many sectors healthy. So that's why I agree with you, Blake. We're not going to see 6 cuts. And the only reason we would is if the economy is way weaker, later on this year. I think that's a distinct possibility, but that's the opposite of what Wall Street is thinking.
Yeah. Okay. Well, maybe they're just looking at the Empire State Manufacturing data. I don't know. Who knows?
Let's blow it out of proportion.
I guess. All right. So let's go back to your charts and let's talk about. You brought the dollar. The dollar has recovered this week. It broke out. How? And you've been expecting a dollar recovery.
Right.
How far do you think this is going to go?
Well, we've been talking since late December, and my take was the economy wasn't going to be weak. People were overreacting to the idea of how many cuts cut in March, and that based on that being rolled back, the dollar would rally. Plus, I could count 5 down, which implied you're going to get a retracement rally. And since late December, it's like, where's the obviously stopping place? 104. And there were a number of trading days in December, mid-December, like 104.25, 104.26. So that area up around 104-ish is a stopping point. And, this rally, my take is, will be an ABC, a counter trend rally. The longer term trend of the dollar, in my view, is down at this point. That 5 down means, okay, we're going to get a bounce, but after this bounce is over, there's another leg down coming. Now, this bounce could subdivide. You could have 3 waves up for a wave A, another pullback, and then another. So it could stretch out for another month or so if it gets a more complicated pattern. But the bigger picture from my perspective is 5 down equals a retracement rally that'll last however long it's going to last. But once it's over, I think the dollar is going to take out 100 at some point in time in 2024 and could get down as far as 96.
Everybody's so bearish the dollar, Jim. Everybody's so bearish the dollar. I'm trying to jump in your camp, but I'm not quite there.
Yeah. Well, again, I think for me, it's the pattern.
Yeah.
I mean, could it retrace more than 104.20? Of course it could. Could it get up near 105? Yeah. I don't know what like 618 of the drop is probably up around 105. From the 107.34 to the 162, 618 of that added to 100.62 is probably up near 105. Could it get up there? Yeah, of course. Because it's going to take a little while, I think, for weakness to appear.
Yeah.
So again, that's my outlook, is that as the economy slows, second half of the second quarter, and then it's more as we approach mid-year and beyond, the Fed is going to be cutting rates, but it's going to be for a completely different reason than Wall Street expects.
Well, Jim, I'm trying to get in your camp that is going to hell in a handbasket. I'm just not quite there yet. But let's talk a little bit about gold. So gold is threatening. I mean, we challenged 2,000 this week.
Yeah. Again, my take has been that we were going to see a rally above 21.22, and once we got that rally, gold would then have another multi-week, 2-3 month pullback. The break of that trend line, because as I said last week in our talk, needed to hold that trend line. So the fact that it broke that trend line, I'm sure some stops got hit underneath it.
Yeah.
And we've seen this rebound. I think gold can rally near term to the 2060, maybe slightly above that. But I think the odds of it getting above 21.22 have decreased significantly with the break of that trend line. And so I think you get a bounce, and I think ultimately gold is going to have another pullback that would imply a decline below 1974, I think, at a minimum. And, there's still, a small probability, but it's still a real one, that gold could drop to the 1812. In other words, the decline from May to 1812 was wave A. The ABC up to the 21.22 is a B wave. And the sharp break was one of C, and we've had a bounce and we're chopping around. And that ultimately, the C wave from the May high of last year will take it below 1812 before things really turn around and gold makes a move, I think, above 2,300.
All right. Well,
So
we'll see if
right now as I said last week, you had to hold that. I thought you had to hold that trend line, because the bullish count is that you've had a 1-2, 1-2, and you're about ready to explode. Well, breaking trend lines doesn't jive with that wave pattern.
Yeah. Okay. All right. Well, tell us what's going to happen in yields, because this is probably going to help with every story that you've been building thus far. So what are you expecting here?
Well, in late
had a
December,
nice little rally in yields. Is that going to continue?
Well, late December when we talked, I said I thought we have 5 down in Treasury yields. That implies we're going to get a retracement rally. The most likely target would be wave 4 of lesser degree, which was 4.29, which is why for the last 3 weeks I've been saying I think the 10-year can get up to 425 to 430, and we're making progress toward that level.
Is this the 200 DMA right here, Jim? This green one?
Probably not. I don't know.
I
doubt it.
believe it is. Just
Okay.
because the 10-year the notes market is trading below the 200 DMA. So I'm thinking that's what that is right there.
I'll look that up. I mean, I'm not a big fan of the 200-day. That's why I don't think it is, but I might have thrown that on there and just out of curiosity type of thing. So,
yeah. But
again, the bigger picture is that 5-wave decline in Treasury yields after the peak in October. And, last October, we were talking, got 5 up. We're going to have a decline here in Treasury yields. That 5-wave decline in yields to late December implies that after this retracement of yields moving up, we're going to see another decline in Treasury yields. And I think the 10-year is going to get under 3.4. Why? Well, because it was 3.25 in April before this move up to that almost 5% level. So what would cause Treasury yields to drop that much? And the only thing I can come up with is the economy really starts to slow more than people are expecting. all of a sudden the idea of the Fed cutting more aggressively. Oh, wait a second, they're going to cut more aggressively. That's how Treasury yields could get down there. And that obviously dovetails with the outlook for the dollar.
Yeah.
They're
Yeah,
kind
because
of
that
they're
would
moving
explain how the
inversely.
dollar gets down to the levels you were
Yeah, I
discussing.
think, yeah.
All right.
So,
Well, the next chart you brought was a table, and I'd like for you to explain what this means.
yeah. So all I did is I went to the intraday highs. It was either like December 27th, December 28th, depending on the average. What was the high? And then this morning, about an hour ago, where were they trading? And then I calculated the percentages. So semiconductor stocks since December 27th 28 are up 3.9%. Well, that's helped obviously lift the Qs up 0.7, the S&P up 0.2 from where it was in late December. But when you look at the broad market, it's not NTSC, it should be NYSE. I messed that up.
All
Anyway,
right,
you
I'll
can
fix it for
see.
you. There we go.
Thank you. Wow, you're a talented guy.
Thank you.
So the point being is you move away from where the concentration is, both in terms of money flowing into semiconductor stocks and specifically in NVIDIA, that has lifted the Qs. But as you move away from the big cap, you can see what's happening to the broader market. I mean, for the difference in the S&P and the Russell to be, almost 7.5% in 3 weeks. I mean, that is anything but strong. And so what this, from my perspective, is showing, as we see this march to new all-time highs in the S&P, which has kind of been my bias, I've said, okay, we might have a pullback, but I think we're going to higher highs before we have a more significant top in the market. That, these numbers really, really support that outlook, because underneath the surface, things are way weaker than what it looks like. And you're right. You asked the question, gee, the market's been really strong. Well, that's the impression you get when you look at the Dow and the S&P and the Qs. But, so again, I think as we make a new high in the S&P, and the next chart is the S&P, so we might as well take a look, is getting above 48.18, has been my bias. It's like, okay, I think we're going to a new all-time high. Is it possible you could get up to 5,200 on some kind of a blow off? I've kind of dialed that back near term, Blake. I don't think that's likely, but one would think that if the S&P gets above 48.18, closes above that, we'll see some additional strength
Absolutely.
next week, and I think we're going to be at a fairly meaningful high at that point in time, given the negative divergences that are building. And unless, all those other averages and the broad market really, really starts to improve, we're setting up a classic divergence where you have some averages making new all-time highs, other averages, in this case, like the Russell, its high was like 2,400. I mean, it's below 20% below where it was in November of 2021. All right. So you got these gigantic divergences. And what that is a reflection of is a fractured market. It'd be like your 6-cylinder engine is operating on 3 or 4 cylinders. That would probably not be a smooth ride, and you probably wouldn't have very good acceleration when you step on the gas, right?
Sure. Yep.
And the advanced decline line. A few weeks ago, in one of my letters, I went through historically how divergences between new highs in the S&P and the AD line making lower highs. I mean, that's what happened in January of 2022, in October of 2007. And I went back because I was looking at the 17-year cycle. And consistently, that's what you start to see is the buying gets concentrated in a smaller and smaller group of stocks. And once those stocks then give up the ghost, the rest of the market doesn't have the strength to compensate.
Hence you look around at the Russell 2000, which will probably get clobbered. I mean, it's just it's technical analysis 101, and it's interesting when you hear so many other macro economists really predict that the Russell 2000 is going to outpace the S&P this year. It's like,
really? I
That's
mean,
it.
it
That's
had a
that's what I
breakout.
say. Really?
Yeah,
But
yeah. Well, we looked at the chart of the Russell last week, and the
mhm.
point being, hey, you had this breakout, and then it collapsed. Well, if that doesn't look like a false breakout, until, okay, if it somehow manages to recover and get back above that breakout and make high, okay, then you got to change your opinion. But what you're saying, Blake, is predicated on the idea of there won't be a recession this year. We don't have to worry about any kind of real slowing in the economy because their idea is, well, if the economy keeps chugging along, these small cap stocks are going to benefit from decent economic activity, and they're cheap relative to the mega cap stocks, blah, 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 blah. And again, when I look at all these charts, they seem to align with the idea that we're going to see some strength for a while in the economy, but then I think the worm turns. We're going to see a market slowing in the economy. And that's why these markets, I think, the pattern-wise, are giving the signals that they are.
Jim, I'm going to leave with everybody with one last visual because a couple weeks ago, you said a number and I was like, I scratched my head and I'm like 4,900 in the S&P. How the hell does he get there? But not to go back too far to like a month ago or sometime in December when you said that. I just want to show something to everybody really quick. If you take this leg right here, you make an equal leg. This is going to take us to this will take us to 4,900 should we get there. And one thing that you don't have on your chart, which I tend to always keep on mind and I have for decades, is relative strength. Relative strength, talk about divergent, is very divergent. So on a new high, relative strength would be divergent at that point. So, just to your point from literally a month, maybe like 5 weeks ago when you said we could get to 59 or 4,900, just doing some technical work in today's market shows us how we could get there, showing that divergence, and combined with what you're just telling me a few minutes ago, or telling us, excuse me, a few minutes ago, you got to be real careful as we hit new highs. So I think.
I think it's going to set up a good short trade in the S&P.
Right.
I mean, that's my conviction level, is that all these negative technical indicators mean something. And what'll happen is the reason to sell will show up. It might be that the economy slows. It might be that the war in the Middle East gets worse, or some other things that
whatever the market wants to cling on to for the day, right?
Well, again, what happens so many times with the technical stuff is you get these negative divergences, and then all of a sudden something happens.
And something
the
matters.
market gets flat. Yes,
or
but it was
matters.
kind of like, if the technical divergences, I've seen this happen repeatedly, where the technical strength of the market is really good and strong. You get some bad news and the pullback is like 3%. You get a technical setup where everything looks weak, you get some bad news and you're down 10%.
Yeah.
It happens all the time. And again, it underscores, one of the messages that we've given is that looking at technical analysis is imperative. Not just looking at fundamentals. You need to look at both. And the reality is the vast majority of economists, certainly Wall Street analysts, only look at the fundamentals. And I think they're missing important parts of the overall picture.
I think every macro analyst needs a Jim Welsh in their back pocket. And guess what? You guys and gals here on the Traders Summit, you do. So make sure you give him a big thumbs up, subscribe to the channel. Email Jim. What's your email, Jim?
Jim Welsh Macro @gmail.
And ask for his most recent technical review. Say you saw him here on the Traders Summit, and he'll send that over to you. Jim, I want to thank you really for keeping us on track all the time. And I love having these conversations with you every week. Sometimes I'm not on board with your ideas, but in the S&P's case, I think I am this week. So, so thank you for that.
Well, we're good for a day.
Yeah, that's right.
It's almost like being king for a day.
Hey, well, thanks, Jim. Being here with you every week makes me feel like a king. So thank you so much.
Wow, Mr. Buttercup.
That's really mushy. You guys, we're gonna get a lot of backlash in the comments for
as well. You should forget the we on that one.
Jim, thank you so much for spending your time with us.
You got it, buddy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.